triple-digit silver for 2026 as high as $309. Gold and silver markets are as dead as they were in 2008. Silver is draining from the Comex. This is technically true, but it's also not so much true. Since gold's bottom at 4,400, we have gone almost back to 5,000. Now we're down to about 4,700 again. Open interest in the gold market has fallen below 400,000 for the first time since the 2008 financial crisis. It's whenever this oil crisis that is currently unfolding forces a bank collapse, and then the Fed has to come in and print trillions of dollars. That is absolutely going to happen at some point. Not sure why, but from the street we have Bank of America revamped silver stock price target for 2026. $309 target is a different animal. It would need a liquidity event, a delivery squeeze, or a surge in physical demand that overwhelms paper markets, all of which could very easily happen this year, and I think will. At this point, inflating more would just destroy the dollar and would bring gold and silver to infinity in dollar terms, and then everything would have to be priced in gold and silver. Activity in the gold futures market is basically dead.
Well, it just so happens that your friend here is only mostly dead. There's a big difference between mostly dead and all dead. Please open his mouth.
Hey guys, Rafi here from the Endgame Investor, and we're definitely in very weird times in markets. All over the place, nothing makes any sense. According to the IEA, the International Energy Agency, I think it's called, we're in the worst energy crisis that has ever existed, and markets don't seem to care one bit. Gold and silver markets are as dead as they were in 2008 during the depths of the financial crisis, and nobody really knows why. We have Hank Paulson, remember that bailout guy from 2008? He's saying that we have to have an emergency break the glass plan for when the treasury market implodes, and he's basically predicting the endgame in so many words. And I'm going to respond to people who think that silver is being drained from the Comex. My answer is yes, it is, and no, it isn't. It all depends on the time frame that you're looking at. So I wouldn't take those missives all that seriously, though I do track the Comex. I track it in a larger context and not just what has been happening in the last few months. And by the way, Bank of America is predicting triple-digit silver for 2026 as high as $309. And no, that's not a joke. And actually, this prediction is kind of old. It's from February. Still post-silver crash of January 29th, but it's not very common when a big mega bank like this predicts triple-digit silver and explains why. So we'll go into that right now.
What looks like silence in this market may actually be the sound of large money stepping back before a bigger shift. As Rafi Farber points out here, gold and silver trading activity now resembles the frozen conditions seen during 2008, even while energy risks and treasury stress are building in plain sight. When former officials begin talking about emergency plans, seasoned investors should pay attention, because those conversations rarely happen without deeper concern. Bank forecasts on silver are also becoming less dismissive, which suggests institutional thinking may already be changing behind closed doors. Next, Rafi Farber discusses why the futures market may be sending a louder warning than price itself.
Let's go with the first one here. We're going to start with gold, and then we'll get into silver. You can see on my little black trapezoid on the right side here, since gold's bottom at 4,400, we have gone as far, almost back to 5,000. I think about 4,950 or something, and now we're down to about 4,700 again. But in that time, open interest in the gold market has fallen below 400,000 for the first time since the 2008 financial crisis, and it has remained there, which means that activity in the gold futures market is basically dead.
Well, it just so happens that your friend here is only mostly dead. There's a big difference between mostly dead and all dead. Please open his mouth.
Why is this happening? That is a big mystery. But it does mean that when activity fires back up again, there's going to be a lot of speculators who are going to pile in when the next move starts, when the next gold rally starts. When exactly does that happen? Well, in my personal opinion, it's whenever this oil crisis that is currently unfolding forces a bank collapse, and then the Fed has to come in and print trillions of dollars. That is absolutely going to happen at some point, whether it will be triggered by this current oil crisis, which the IEA calls an oil crisis, the worst that we've ever experienced. Why aren't markets reacting to this? I don't know, but eventually they will. It's the same reason why the people in the Big Short didn't understand why housing markets weren't reacting to the collapsing subprime market and why bonds weren't reacting to it either.
Sometimes the most important market signal is not price but the lack of participation underneath it. As Rafi Farber points out here, gold moved sharply while open interest dropped below 400,000 contracts, a level not seen since the 2008 crisis. That tells investors the move may not yet reflect broad speculative enthusiasm, which often appears later in a cycle. When liquidity returns after a policy shock or banking event, the reaction can be far more violent because positioning starts from an unusually quiet base. Next, Rafi Farber talks about why extreme calm in futures often appears before major financial repricing.
The bonds aren't going down. They won't move. It's possible that we are in a completely fraudulent system.
But eventually they did. There are some delays in these things, but they eventually all happen, and it will happen again this time. You can't block the Strait of Hormuz and expect no fallout, and that fallout is yet to come. The deadest gold futures market since 2008. Just zooming out on this chart here, you can see open interest. I drew a line over here where we are now at about 366,000 contracts. The last time we were below this line was during the 2008 financial crisis. And this means that there's like something big happening in the gold market right now, as there was something very big happening here at this extreme in 2008. And there was also something very big happening here at the beginning of 2020 when gold open interest for some reason reached a maximum of 800,000 contracts. To this day, nobody can give me a good explanation as to why this was happening right before the lockdowns. Did somebody know something? Was it connected? Nobody knows, but it was a big thing. It was a big deal. And so when there are extremes in open interest, we might not understand why, but it does signal that something big is happening in the market, and it is happening right now. You can't see it in price, but it's happening in other areas. Bank of America predicts triple-digit silver this year. This is actually from February 28th, and it's making the rounds now.
Markets often reveal stress through behavior long before they admit it through headlines. As Rafi Farber points out here, gold open interest near 360,000 contracts places participation back at levels last seen during the 2008 financial crisis. Extreme readings like this have historically appeared around moments when confidence quietly shifts beneath the surface. Investors sometimes focus too heavily on price while ignoring positioning, even though positioning can expose whether institutions are preparing for a different environment. That is why low activity can matter more than a dramatic chart. Next, Rafi Farber unravels why silver forecasts are suddenly becoming harder for Wall Street to dismiss.
Not sure why, but from the street we have Bank of America revamped silver stock price target for 2026 by Hillary Remy. Bank of America just made one of the boldest silver price calls on Wall Street. Michael Widmer, the bank's head of metals research, projects silver could reach anywhere between $135 and $309 per ounce before the end of 2026. That's a low call of $135 and a high of $309. This is a real thing. This isn't gold or silver bugs that have suddenly invaded Bank of America. This is a normie guy, as much as I can tell. The $135 base case assumes a natural bull market continuation without a squeeze or panic buying. The $309 target is a different animal. It would need a liquidity event, a delivery squeeze, or a surge in physical demand that overwhelms paper markets, all of which could very easily happen this year, and I think will. One of them will, or maybe both of them will, or all three of them, however many there are. I don't know. On that note, we have another panic call, not quite panic, but he's saying prepare for panic, by Henry Paulson, aka Hank Paulson, the Secretary of the Treasury during the 2008 financial crisis, who basically bailed out everything under George W. Bush. So he says, with regard to any breakdown in the $31 trillion market for U.S. government debt, Paulson said that would pose a different case from the financial crisis he dealt with while the Treasury's helm 2 decades ago.
When a major bank starts entertaining extreme silver targets, investors should notice what changed inside the institutional narrative. As Rafi Farber points out here, Bank of America is no longer treating silver as a fringe discussion, but as a market that could react sharply under liquidity stress. Even the lower range of that forecast signals that some analysts now see structural pressure building beneath paper pricing. Pair that with renewed concern over a $31 trillion treasury market, and the message becomes harder to ignore. Next, Rafi Farber discusses how debt market instability could reshape precious metals faster than most expect.
This is from CNBC, by the way. As bad as it was, he says, about the 2008 financial crisis, the government had fiscal firepower to address the credit meltdown. You can come in and clean up the mess, but in the event of a U.S. public debt crisis, when you hit the wall and you're trying to issue treasuries and the Fed is the only buyer and the prices of the treasuries are going down and interest rates are up, that's a dangerous thing. You know what it is, Hank? It's called the endgame, and there's nothing you can do to stop it. He says we need an emergency break the glass plan for when this happens.
Shoot the glass.
I don't know what that plan could be, because the only thing that can be done is to inflate more, and at this point, inflating more would just destroy the dollar and would bring gold and silver to infinity in dollar terms, and then everything would have to be priced in gold and silver ounces instead, and we'd be at endgame fully, which is what is going to happen. Will it necessarily be this year? I certainly hope so. Now, as for commentators that are saying that silver is draining from the Comex, this is technically true, but it's also not so much true. It depends on context. I'm not criticizing these people. I'm just saying to broaden out the views here and understand what they're saying in the context of what's happening since the 1970s, or at least the 1990s. So we see here silver draining from the Comex.
Debt markets rarely break in a straight line, but when buyers disappear, pressure builds quietly until it doesn't. As Rafi Farber points out here, the risk isn't just rising US debt at $31 trillion, but the scenario where the Federal Reserve becomes the only real buyer of treasuries as yields rise and prices fall. That combination signals stress in the backbone of global finance, not just volatility. The claim that inflation is the only solution also highlights a deeper issue: policy tools shrinking as leverage expands. Next, Rafi Farber discusses how even technical truths like Comex silver flows can be misleading without historical context.
Yes, that's true in the sense that we were at about 530 million ounces, and now we're at 316 million ounces. So that's over 200 million ounces drained out in just a few months. That's all true. But when it comes to context and how high are silver inventories at the Comex, they're still pretty damn high. Higher than they were at the highs in the 1990s. We're very near the recent highs of 2021, slightly below them. But if we look at the registered stocks by themselves, we are right near, and this is as far back as the data for strictly registered silver supplies go, we're near what highs were before 2021, right? 80 million ounces, 79.28 million ounces. This was around the highs that were seen from 2000 to 2020. There's no shortage here. There's still plenty of silver, plenty of registered silver for sale on the Comex. And while some of it is leaving, these things go in waves. So I won't be paying much attention to this until we get somewhere around these levels in 2023 or 2016, and that is critically low. We're still plenty of space away from that. We'll see if we get there, and I will keep my eye open. Is gold really draining from the Comex? Well, same story here. This is the total gold supply, both registered and eligible, meaning for sale and not for sale, 29.44 million ounces, total Comex gold stockpiles.
Market narratives often exaggerate scarcity while ignoring scale, and that gap matters for investors. As Rafi Farber points out here, Comex silver has dropped from about 530 million ounces to 316 million. But even that level still sits above multiple historical peaks, including the 1990s. The key contradiction is perception versus inventory reality, where headlines suggest crisis, while data still shows significant supply buffers. That doesn't remove risk, but it challenges emotional trading decisions driven by flow stories alone. Investors often misread short-term withdrawals as structural shortages. Next, Rafi Farber shows how even gold inventories remain historically elevated despite recent declines.
So we're at just below 30 million ounces. And if we go back 2005, I could go back to all the 1974 all the way, but numbers didn't really change much from 1974 until about 2020. So we see here that we're still at very high gold supply here on the Comex. And yes, it has drained out from about 45 million to 30 million in about a year and a half. But that's happened before. And it happened from 2020 to about 2025. So we still got plenty of room here, and there's no critical mass or critical situation on the Comex in gold supplies at all. But there is something happening in the futures market that could pick up some volume and some open interest. The margin requirements are going down. For the gold contract, we see the current initial margin requirements are 7.7%, and they're going down to 6.6%. That's a meaningful move down. Also for silver, we see they're at 15.4% and going down today, Friday, to 12.1%. So this will increase leverage on the Comex trading platform and will draw in more traders as they can afford to spend more money on contracts because margin requirements are lower. We'll see what that does to the market if it wakes it up a little bit. Silver is still in its lowest activity since 2008. I mean trading activity on the silver futures market in New York.
Lower margin requirements don't just make trading easier, they often amplify risk-taking at exactly the wrong time. As Rafi Farber points out here, gold margin falling from 7.7% to 6.6%, and silver from 15.4% to 12.1%, effectively increases leverage in a market already showing historically low participation. That combination can temporarily wake up volume, but it also raises sensitivity to shocks once positioning builds. The irony is that easier access can create more instability, not less, if underlying liquidity remains thin. Investors should note that structural calm with rising leverage is rarely a stable equilibrium. Next, Rafi Farber unravels how silver futures activity is approaching levels last seen only during crisis periods.
We see here that we are at 114. We're actually at 112,700 contracts because this is a day behind. So 112,000. This is basically a low going back to 2012. And before that, 2008, 2009. And we see here that during these times, there are some extreme things going on in the financial system. In 2011, obviously, we were at the highs in gold. So something big is going on in the silver market, though. It's still trading very, very quietly right now. It's just that nobody knows exactly why and what is happening. But whatever it is, it's big. And there is a potential to fall below 100,000 contracts. Before we go into this chart, I'm just going to go back here for a second. This 100,000 line, you can see I drew a black line just above it to where we are now, but 100,000, that's below this 2011 low. And the only time we were below 100,000 since 2008, since the financial crisis, was the financial crisis itself. We've never gone that low since then. But if we do, here's how it would happen, right? So we have the May contract delivering on April 29th, I believe. I think that's a Wednesday. That's Wednesday of next week, this coming Wednesday. And we see that you have to roll over if you don't want to take or make delivery. You got to roll over for May. The contracts are closing out for May because people don't want to either take or make delivery of silver.
Low activity doesn't always look dramatic, but it often signals stress beneath the surface of liquidity. As Rafi Farber points out here, silver futures near 112,000 contracts are approaching levels only seen during 2008 and the post-crisis period, with a psychological threshold at 100,000, where only extreme market conditions previously pushed activity lower. The key concern isn't price, but participation drying up ahead of contract rollover into May 29th delivery cycles, which can amplify volatility if positioning is forced to adjust. When traders avoid delivery, it often reflects uncertainty in physical versus paper balance. Next, Rafi Farber shows how contract rollovers could trigger sharper dislocations in silver positioning.
I would rather roll over into the next position. So 4,000 have cleared out yesterday and only 2,500 have been bought or have been established since yesterday. It's also yesterday. So a loss of 4,000, a gain of 2,000. That means only half of them, or slightly more than half of these longs and shorts, have moved over to July. So if that continues, we could see about half of these 34,000 being wiped out, being closed out for good without rolling over. Half of 34,000 is about 17,000, let's say 15,000, 14,000, whatever. We're now at 112,000. So we could see a move below 100,000 contracts, which we have not seen since the 2008 financial crisis. Gold and silver equities are still below the 2008 crash lows priced in gold. So this is gold to the XAU ratio. The XAU is the longest or oldest gold and silver stock indexes that I can find here on stockcharts.com. So if we go back to 2000, we can see the lower this is, the more expensive gold stocks are in gold terms. This is how many ounces of gold the average gold stock costs. So the higher it goes, the cheaper, and the lower it goes, the more expensive. So you can see here, we are right at a major pivot line going back to 2008. This was, in gold ounce terms, the 2008 crash lows of the gold and silver equities complex, and we're going to break them, right?
Quiet positioning shifts are often more revealing than price itself, especially when contracts begin to thin out. As Rafi Farber points out here, a potential drop toward 100,000 silver contracts would take market activity back to 2008 crisis territory, signaling reduced participation rather than just volatility. That matters because thin positioning can exaggerate future moves once momentum returns. The gold to XAU ratio also suggests mining stocks are still priced near historical stress levels, not recovery levels. Investors often miss that equity repricing in commodities can lag physical sentiment by years. Next, Rafi Farber discusses why these technical pivots could define the next major move in gold equities.
We've touched it 3 times, once in 2016 at the beginning of the gold bull market, once in 2021 after the lockdown insanity of 2020, and once just now at the beginning of 2026 at the highs in late January. We're going to hit it again because we're not that far above it. We're at 12.41 now, and this is about 11.11, 11.5. See here, the bold numbers is 12.41. So gold stocks haven't moved down much at all, and they are testing this major pivot point. Once we break it, I think we're going to go down, head down to this historic area over here from 2000 to 2008, and gold stocks are going to be fundamentally repriced. So if you still want some gold stocks for your portfolio, there's still time to get some because we're only at the 2008 crash lows in gold's terms. Think about that. Now, one last slide here we have from the director or the head of the IEA. It's called the chief, apparently, according to this headline. This is also CNBC. We are facing the biggest energy security threat in history, IEA chief tells CNBC. Well, you wouldn't know that from the way the markets are operating, which is kind of dead. But anyway, that's what he says. Here he says, describing the Strait, meaning the Strait of Hormuz, as one of the world's most critical oil transit choke points, obviously, the IEA, International Energy Agency, has warned that the closure will impact global economic growth, spur inflation, and could lead to energy rationing. The energy has warned of an imminent jet fuel crunch in Europe, for example.
Market pivots often repeat because liquidity cycles tend to revisit the same psychological levels. As Rafi Farber points out here, gold stocks are again testing a long-term support zone that previously marked turning points in 2016, 2021, and early 2026. The concern is not just price, but whether fundamentals have truly improved enough to justify stability above that band. At the same time, energy warnings from the IEA about inflation and rationing highlight macro pressure building outside financial markets. That disconnect between quiet markets and rising real-world risk is where mispricing often forms. Next, Rafi Farber shows how energy disruption could feed directly into precious metal stress.
With some countries facing shortages within weeks, flights are going to get canceled. Things are going to start happening pretty soon. Europe gets about 75% of its jet fuel from refineries in the Middle East, and this is basically now down to zero. Europe is now trying to get it from the US and Nigeria. If we are not able to get it in Europe, additional imports from the countries now, we will be in difficulties, Birol told CNBC on Thursday. I really hope, first of all, that the strait is opened and refinery exports start from there. But we may well need to take some measures in Europe to reduce air travel as well, meaning we're starting the rationing process. I don't think the Strait of Hormuz is going to open up anytime soon. Both sides are pretty bellicose in their words, and the US seems intent on continuing its blockade until the refineries of Iran are choked out and they don't have any capacity left to store any oil and they just shut down. But whoever is leading Iran, and nobody knows who that is actually, they don't seem intent on giving in to any of this either. And in any case, the Pentagon has said that it would take about 6 months to demine the strait even after an agreement was reached. So we're looking about 6 months until insurance would be able to cover transit again. I'm not sure if any insurance company would want to cover a freighter or an oil tanker that is going through a mine strait that hasn't been cleared out yet. So I think Hormuz is out of commission for the next several months, and we are headed for a very big energy crunch, according to the IEA chief. That's going to happen. It's going to lead to domino effects somewhere, and gold and silver are going to be involved.
Energy bottlenecks rarely stay confined to one sector once logistics start breaking down. As Rafi Farber points out here, potential jet fuel shortages in Europe and disruptions through the Strait of Hormuz could quickly escalate into broader inflation pressure if supply chains tighten further. The mention that flights may be reduced or rationed signals real-world contraction, not just price volatility in commodities. With 75% of Europe's jet fuel linked to Middle Eastern refineries, dependency risk becomes a financial variable investors can't ignore. When energy flows tighten, metals often react as secondary inflation hedges.